the banker who rewrote the rules. It began with a man who refused to accept the limits of the world he inherited. While others saw the financial system as rigid and unchangeable, he saw openings, loopholes, opportunities, unseen pathways that could transform the flow of money across an entire nation. And with every bold step he took, he reshaped the rules that everyone else thought were set in stone. To understand why his story still matters, we have to return to an era when American finance was a fractured landscape. Banks operated with loose standards. Credit flowed unpredictably. Wealth moved unevenly, pooling in some regions while draining from others. Most people believed this chaos was simply the cost of a growing nation. But he didn't. He believed the system could be disciplined, directed, and, if necessary, forced into evolution. He arrived on the scene not with quiet suggestions, but with a fierce intellect and a relentless drive. He studied failures, hunted patterns, and recognized flaws that had eluded others. Where many saw crises, he saw opportunities to rebuild the system from within. His ideas challenged traditions, defied expectations, and threatened those who benefited from the old ways. Yet he moved forward, undeterred by hostility or doubt. His early actions revealed the depth of his ambition. He reformed lending practices, tightened standards, and demanded accountability from institutions that had long operated without oversight. Many saw him as a stabilizing force, a figure capable of enforcing discipline across a chaotic financial frontier. But others saw something more concerning, a man accumulating influence in a way no banker had before. The first ripple effects of his work were subtle. Markets became calmer. Volatile regions experienced rare periods of stability. Banks once known for reckless behavior began adjusting their methods. Supporters praised his vision, convinced that his reforms were paving the way for a stronger, more reliable financial system. They believed he was building a foundation capable of supporting America's growing ambitions. But power always comes with consequence. And as he tightened his grip on the system, questions emerged. How much control should one person or one institution hold? At what point do reforms become domination? The lines between stability and authority began to blur, and people who had once welcomed his changes found themselves uneasy in the shadow of his expanding reach. The early beats of conflict formed quietly, a disagreement here, an accusation there. Rivals whispered that he aimed to shape the system for his own vision, not the nation's. Critics watched as his influence spread beyond banking halls into political chambers, where laws and decisions began to reflect his philosophy more than public consensus. The man who wanted to fix the system had succeeded, but in doing so, he had awakened fears that he was building something too powerful, too centralized, and too dependent on his will. And though no one realized it yet, the rules he rewrote would soon ignite a clash unlike anything the financial world had seen before. The shift from admiration to suspicion happened slowly, almost imperceptibly. At first, his authority felt like a stabilizing force, an anchor in a system prone to chaos. But as his influence deepened, a new sentiment spread through the financial world: unease. People began to wonder whether the reforms he championed were truly for the nation's benefit or for the expanding reach of the institution he controlled. Whispers turned into conversations. Conversations turned into accusations. Rivals who had remained silent now spoke openly, questioning whether one man should wield so much control over credit, currency, and the financial heartbeat of the country. His supporters dismissed these claims as fear-mongering, but the critics were relentless, insisting that concentrated power, no matter how intelligent or well-intentioned, was a threat to democracy itself. Meanwhile, subtle signs of tension emerged in the markets. Banks that resisted his reforms found themselves shut out of opportunities. Loans were delayed. Reserves tightened. Some institutions claimed they were being punished for political rather than financial reasons. Whether these suspicions were true didn't matter. Perception alone was enough to spark conflict. Politicians felt the pressure as well. Some aligned themselves with him, praising his vision and describing him as the only figure capable of guiding the nation through uncertainty. Others accused him of overreach, warning that no banker should influence public policy to such an extent. Congressional hearings grew heated. Newspapers published editorials with tones that felt increasingly urgent, even alarmed. Behind closed doors, Tensions escalated. Letters passed between lawmakers describing the banker's growing shadow influence. Business leaders confessed their fears that he could determine which industries thrived and which withered. Some claimed he had begun favoring certain regions over others, adjusting credit flows in ways that quietly shaped the nation's economic destiny. At the same time, the banker himself continued to push forward. He spoke confidently about modernizing the system, strengthening the nation, and preventing crises before they occurred. His supporters echoed these sentiments, arguing that only a firm hand could prevent the instability of previous decades. To them, his authority was not a danger, it was a necessity. But critics weren't convinced. They saw patterns that alarmed them. Institutions leaning too heavily on his guidance, markets reacting more to his decisions than actual economic conditions, and political debates subtly bending to his influence. Each development added fuel to the growing suspicion that the nation was drifting toward a financial order shaped more by the vision of a single man than by collective governance. Fear crept into the public consciousness. People began questioning whether they were witnessing reform or the quiet rise of a financial empire. Small incidents, a denied loan, a closed local bank, a shift in reserve requirements, took on new meaning, interpreted as signs of creeping control. The emotional tension built steadily. Trust frayed, alliances shifted, and the once celebrated banker found himself standing at the center of a growing storm, one that threatened not only his reforms but the very system he had sought to reshape. The stage was set for a confrontation, and as the pressure rose, the question became impossible to avoid. Had he saved the nation's financial future, or had he placed it in his own hands? The confrontation erupted with a force that neither side fully anticipated. Years of quiet suspicion finally surfaced, transforming what had once been professional disagreements into a full-scale struggle for control. The banker who had rewritten the rules now faced opponents determined to stop him before his influence reached further than they believed any unelected figure should go. The conflict unfolded on multiple fronts. In Congress, lawmakers delivered speeches that felt less like policy debates and more like warnings. Some accused him of manipulating credit to reward allies and punish critics. Others claimed he had built a financial machine so powerful that even elected officials feared opposing him. The accusations carried emotional weight, stirring anxiety among citizens who already distrusted institutions that operated behind closed doors. Markets reacted violently to every development. A single comment from a banker could calm investors or send them into panic. Newspapers documented the turmoil with breathless urgency, turning him into a figure both feared and admired. Editorials questioned whether the nation's prosperity had become dependent on his decisions, and whether that dependence was a sign of strength or fragility. Meanwhile, regional banks began to resist. They saw his reforms as threats to their autonomy, believing that once they surrendered control over credit and currency, they would never regain it. Some quietly organized alliances, pooling reserves and circulating statements condemning the concentration of power. Their defiance only deepened the divide, pushing the conflict into more volatile territory. The emotional pressure intensified as ordinary Americans felt the impact. Loans became harder to obtain. Businesses hesitated to expand, uncertain how the conflict would reshape the economy. Families noticed small but unsettling changes. Longer delays at banks, nervous tellers, unexplained restrictions on withdrawals. These everyday frustrations fed into a growing sense that something fundamental in the system was cracking. Behind the scenes, the banker grew more isolated. Advisors urged caution, warning that the opposition was gaining momentum. Allies became hesitant, worried that supporting him might jeopardize their own futures. Yet he refused to retreat. His conviction hardened. He believed the system needed discipline, and that only his vision could prevent the financial chaos that had defined earlier decades. To him, resistance was proof that reform was necessary, not that it had gone too far. As accusations intensified, the conflict spiraled into personal territory. Critics questioned his motives, his integrity, even his patriotism. They painted him as a man who sought not stability, but dominance. Supporters countered by portraying him as a misunderstood visionary, unfairly targeted for trying to protect the nation from reckless banking practices. Both narratives spread quickly, pushed along by speeches, editorials, and public debates. The emotional weight reached a breaking point when rumors emerged that he was influencing political campaigns. True or not, the claim struck a nerve. People feared that financial power had crossed into political control, blurring the lines between governance and banking in ways that felt dangerous. The build-up toward the climax became undeniable. Confidence in the system wavered. Political divisions hardened. Markets trembled with each new accusation. And at the center of it all stood the banker, brilliant, determined, and increasingly embattled, fighting to defend reforms that had once made him a hero but now threatened to turn him into the most controversial figure in American finance. The nation braced for the moment when the conflict would finally break open. And when it did, nothing would remain untouched. The climax arrived with a jolt that reverberated through every corner of the financial world. After months of rising tension, the president publicly moved to dismantle the centralized power the banker had built. In one decisive announcement, government support was withdrawn, political alliances collapsed, and the foundation of his influence cracked open in full view of the nation. The reaction was immediate. Markets shuddered. Newspapers erupted with headlines that framed the moment as either a heroic defense of democracy or a reckless attack on stability. Supporters of the banker warned that undoing his reforms would return the country to the chaos of earlier decades. His critics insisted the move was necessary, arguing that no unelected figure should wield such sweeping authority over credit, currency, and the nation's economic fate. Inside the institution he once commanded with absolute confidence, the mood shifted from determination to disbelief. Strategies that had seemed unshakable now looked fragile. Senior officers scrambled to respond as funding evaporated, loans tightened further, and regional banks, emboldened by the president's actions, began openly challenging the system he had engineered. The fortress of influence he had spent years constructing was weakening one stone at a time. The true emotional peak came when he realized the battle was lost, not because his ideas failed, but because the nation no longer trusted the concentration of power behind them. The same reforms that once symbolized strength had become symbols of overreach, and as the tide turned against him, the institution he reshaped collapsed under political pressure and public suspicion. In the aftermath, the financial world entered a period of quiet reflection. Leaders studied the breakdown, searching for insight in the ruins of a system that had risen quickly and fallen just as fast. They learned that innovation, no matter how brilliant, becomes a liability when it leans too heavily on a single figure, and that systems meant to create stability must be built on shared trust, not individual authority. The reforms he championed were not forgotten. Many survived in new forms, adapted and integrated into future systems. But his downfall became a reminder etched into the nation's memory. Power in finance must be distributed, balanced, and constantly questioned. Because even the most visionary ideas become dangerous when one person holds the keys. Subscribe to join the journey.